Today is Tuesday, and we're coming at you with a brand new segment, something we've never done before. Tell them what it is, Stallion.
Welcome to the IBC Roundtable. This is a segment designed to drop every Tuesday to teach you more and more about the infinite banking concept, to answer those questions like, how can I grow my policies? How can I learn to do more with what I have and master this process for me and my family?
There's not enough time on Thursday because Joey never lets me talk the amount of time I want to. You know that. You've heard this happen. But today and every Tuesday going forward, we're going to take those conversations that you're having with us and our coaches, and we're going to break them down, help you get over those hangups, make infinite banking simpler so that you can take action.
That's right. This week's episode, we're talking about one of the biggest questions we hear from you each week. How can I exit the 401k casino and get more control of my own money?
Seriously, who wants to put money in mutual funds? Let's get out of that crap. We've been wanting to figure out a better way. Today's conversation is about how do I do that? Is there a way? Is there a plan? And by the way, did you know, Joey, that the government just released a new program that allows for this to happen without a penalty?
That's right. Ding, ding, ding. You're going to want to tune in to this episode to learn how we're taking advantage of that right now.
By the way, before you do that, Joey, I tell them about one more thing. Okay, can I say one more thing?
Absolutely.
Don't miss out on our inner circle. This is our mastermind where people are going deeper into live Q&As, participating in this roundtable, and much, much more. So head on over to wealthwithoutwallstreet.com/inner circle. Let's belly up.
Welcome to the Wealth Without Wall Street podcast, your guide to understanding how to get out of the Wall Street rat race and start your own mailbox money lifestyle. Now, don't let these handsome Southern draws fool you. These financial minds are teaching our country to enhance savings, increase cash flow, and create passive income, all without the help of Wall Street. Are you ready to break through? Now here are your hosts, Russ Morgan and Joey Múre.
Welcome. I'm your host, Joey the Italian Stallion Múre, and I'm joined by Russ. You know him, you love him, the idea guy, Morgan, the man who's not afraid of wearing pink socks with his lobster shirt. Russ, how you doing today?
Man, I'm great. I'm glad to be here. This is a chance that we get to share, bring new people into the discussion, talk about something that I love to talk about, which is how much I hate Wall Street.
That is a great topic, and we're going to have a lot to talk about. But before we get to it, I also want to introduce to you downtown Ernie Brown, the man, the thinker, the guy with few words, but when they come out, they blow you away. Welcome to the show, Ernie.
Yeah, thanks so much, guys.
All right. Now, Ernie, you have to give us an up-to-date. What are people talking about right now? You're one of our coaches. You're on the phone with people every day. What are some of the topics people are bringing to your mind right now that they're looking for?
Yeah, which is part of the reason that we want to even have this time is what are people experiencing? Why are they coming towards IBC? What are people who are using IBC? What are they doing? Stuff like that. And just this week, and we've had several meetings with folks, and a few of those, wide reasons why people are doing this. It's infinite, right? But this week, talked to a guy 10 years ago, got really serious about saving money. And his main goal was wanted to have cash saved for college, for his kids' college. At least a couple of them, from what I could gather in that in that conversation. And picked an insurance product. And for 10 years, it's just been throwing cash in there, but is now coming to us and saying, I need to do more.
You said picked an insurance product. So normally you would have said whole life. It was whole life. So clearly it was something different.
Something different, something that he went to a friend. Hey, my friend can do insurance for me. I like the potential tax benefits of putting cash in here. Right. I like that once my kid goes to college and I use the cash in the policy to do that. After college, the policy will still exist. But it's an indexed universal life policy.
Okay. IUL, people refer to that sometimes.
That's right.
All right.
That's right.
And for those that have been following our book review, you would know this back a handful ago, Nelson, in his book, actually addressed index universal life, variable universal life, and didn't have a whole lot of good words to say about them, did he?
No. He said that they're really kind of just playing the game with those products. They're trying to mimic market returns in something that was never really intended to be an investment vehicle. Life insurance is not meant for that. It's more for savings, not investing.
That's right. And I mean, we think about who we're about to talk with. Mark has some experience with these types of policies.
Yeah,
That's where he got started in IBC.
That's right.
So Ernie, so you're talking to this person, they're trying to find a way to save for their kids and for their kids' college, and they've been putting money here. How has it worked for them?
Well, it's been working, and he threw out some cash values that are in the policy, and it's fine.
Okay.
The shortfall of that is we want to put cash into these types of policies so that we can use it. And to this point, he hasn't used it once.
He hasn't taken any long. And I think that's a common thing we see, right, Joey, is that people start to save money, which savings is a wonderful thing, but they're not using it. If they're not actually getting that money to work for them, sometimes they start to come back and they realize, man, I'm missing out. Let's talk about somebody that maybe you would have come across this week, maybe any sort of discussions that would address that.
So, well, first of all, I don't want to get too far down the road, and we can address this more as we go, but something that kind of has become a newer thing in our minds, like that we're starting to realize, is we don't need to muddy the waters on where we save and where we invest. And what's the difference between whole life insurance and the product of whole life insurance and the process of infinite banking? So this is just a great example. Someone is saving money in a product, an IUL product, right? We could differ on why that would not be the best place to do it. But the real difference becomes, has he been practicing the process of infinite banking? The answer is no. And
he just didn't know about it.
Exactly.
He's now coming to us to talk about the infinite banking concept.
That's right.
And so we're just getting to know him, know what he has been doing, and no doubt he's going to be making some adjustments.
Well, if you think about this too, I mean, the whole topic today, right, is the 401k a casino? And if it is, when should we get off that roulette table, right? When should we exit the casino?
That's right.
And a lot of these 401ks, or we will commonly refer to them as qualified plans, there's a lot of different types of qualified plans. There could be IRAs, both Roth and traditional. There could be SEP IRAs. There could be simple IRAs. Basically, there's an IRA for anything you can think of. There is 401ks. There is the
403Bs.
403Bs. There's TSPs. We also have, for kids, we have 529 plans, right? So
that's right.
For him, he was trying to save money. He was trying to find a place to save. He was trying to look for an alternative. Maybe, I guess it sounds like instead of the qualified plan, 529 plan, he chose that. All right, really quick, I'm going to come back to you because I know you talk to a lot more people than Joey and I do on a regular basis.
That's
but
right.
Joey, let's hear from you.
All right, so one of the highlights this week, just talking to one of our podcasts, we were on the host of that podcast, and he was sharing with us how he has kind of gotten creative about his investing strategies. He's actually the one co-signing or signing for a construction loan on new construction homes that he and a builder have partnered on. And the end user of that new home is an investor who's looking to rent that property on a long-term rental, like a turnkey property in that case.
So he's a lender in the process. He's looking for a little appreciation in a short period of time and a quick exit.
Yeah, the split of that equity whenever it sells.
All right, so what's the goal for somebody like that? Why would somebody at his level, why would he be looking at that?
Well, I mean, to be honest, we didn't get too deep into that, but I know the current situation is he's planning for his daughter's wedding, and he said, yeah, we're going to need to do a few more of these just in preparation for that.
But is there some level to that of fast cash, do you think?
Oh, yeah, absolutely.
Because, I mean, I would, if you're listening to this, you hear the opportunity to lend money as someone built a house, turn around within, 4 to 8 months,
right,
and turn it and sell it for $40,000 to $50,000 profit. That's quick cash, right?
That's right.
We see that in the fix and flip world. Sometimes we even see it in a much faster way in the wholesale market. That's fast cash. But here's a problem though with that method. I just want to, again, I love when people find creative ways to make money. Unless you do it over and over and over again, it's not cash flow.
That's right.
And we just heard last week from our Q&A guest, Pace Morby, he said, we don't pay bills with equity. We pay bills with cash flow, right? So we got to come back to this. And I think that is a problem that I see in these qualified plans is that they don't create cash flow, do they?
No.
It's just another place to store money.
That's right.
So, Ernie, what other stories have you heard this week? What other areas have you seen people seeking some form of freedom and maybe haven't gotten there because of some areas that they've been working in?
Well, another guy, just talked with him this morning. He's been investing in real estate and got approached. Is sort of in some instances, a dream scenario. An investor came in and said, hey, I want to buy these properties for you. So he's getting ready to offload them. This seems pretty common for this guy. He's got lots of opportunities in front of him, but he's trying to figure out what best to do with this windfall of cash that he's about to get. Because it's not cash flow right now, it's a windfall.
Mm.
And so we're getting together, talk about infinite banking concept, and he's going to optimize that.
He needs a place to put that money. And that's a tough thing. How many times have we been approached by people that says, hey, look, I got a lump sum of cash. How do I start one of these insurance policies?
Well, in light of what we're talking about today, the CARES Act, and the provisions in there, we're getting way more of those calls than normal.
When you say the CARES Act, for those who have not followed and didn't listen to our tax attorneys cover that, expound upon that a little bit more.
Which, by the way, disclaimer, you need to listen to those guys, the tax attorneys and those guys that are fully, they don't have to.
So
have
when
a
you say
disclaimer.
go listen to them, that means go to the events, go in the past events, click on the Financial Freedom Live, and you will see a segment that we did with the CPS, our tax attorneys, and they covered the CARES Act. So
that's right.
There's your disclaimer,
There you
Joey.
go.
Now you can talk. You're only repeating what you know. Does anybody believe that Joey has 100% of the information? I didn't hear anybody say
There's
yes.
crickets. I heard crickets.
But we know that this isn't you telling them what to do.
Right.
But talk a little bit about that.
Okay, so bottom line is you can, through the CARES Act, you can now optimize or take out up to $100,000 out of a qualified plan without having to pay the 10% penalty for taking that money out prior to age 59 and a half.
And that's a pretty cool thing, by the way.
It's huge.
Because here's the question I think we're going to cover today. Is this the best time to get money out of a qualified plan that there maybe has ever been?
I don't know. What do you think?
I'm going to hold on to that answer just a second.
Cliffhanger.
Yeah, well, here's one thing. I do want to talk, I don't have as many conversations as Ernie does and probably even less than you, but I try to stay to the pulse as much as I possibly can. And I had a conversation with a guy that has 8 kids, and he's getting after it in many ways. Business is what I'm referring to, though. Okay. But here's one of the things that he told me. He said, look, I want to find a way to set my kids up to where they can be in a position to do what we are doing personally with our businesses by borrowing against these insurance policies. I don't want them to create a mindset of storing money in a place that they can't touch, because if they have the same entrepreneurial passions that I have, I want them to be able to access that money. Well, now his oldest kid is 16. He's trying to create a policy for his 16-year-old that he could go do something with. What do you think a 16-year-old needs, Ernie?
He needs a car.
It needs a car, right? And
That's what I needed.
He wanted to show his son how to take a policy loan and what that looks like so they could go buy a car for him. And so then he can start paying it back, and he can start building that mindset of my capital has a cost.
That's right.
I need to put it in a place that I can access that's protected, but I can make sure that I can use it over and over again. And we're challenged by that. We're challenged because about the amount of money he wants to put in on these 8 children. The insurance company actually has some reservations. People don't know this, but insurance company will not give you all the insurance you want. And our guest today is going to even talk about how he's trying to figure out ways to get more into policies and how that he has certain limits. And we're going to discuss that. All right, so let's talk about just from a external area. There's these wants our clients have.
That's right.
What is really keeping them from getting there?
Well, today, I'm going to say it's qualified plans.
Okay, explain.
I'm saying that there's a mindset that comes with qualified plans that says defer your money, put it in here, put it into things you don't understand, primarily mutual funds, Wall Street, and just hope for the best. Ride the volatility. You've been taught and taught and taught all these wrong things that are separating you from your money. And I think that is the cardinal sin when it comes to taking control and actually building true wealth.
Ernie, would you agree with that?
Well, yeah, absolutely. But I don't even know if it's as intentional as that. If we've been taught the wrong things, have we actually been learning? Because if you're taught something, that would imply that you're learning something. This is just herd mentality, I think, is the reason that when I was in ninth grade, for some reason, I opened a Roth IRA.
You opened a Roth IRA
in ninth grade. Yeah, we had a financial advisor come to our house, and we made him fried chicken, and he had dinner with us. And at the end of that, he was so impressed at my soccer skills that I got that thing open. But I think herd mentality is just what I was supposed to do. So, man, we got this guy, just an example of that, this guy who got started a few years ago with infinite banking, and it opened his mind. He didn't get access to all the cash in the world, but he started building the opportunity. And so that led him to go find access to cash from other people. And what we found out just a couple of weeks ago, Russ and I did, and Joe, you heard about this too, is that now he's invested in several real estate properties, and he's got a piece of land that he wants to build on. And it's unlocked his mind is what it's done. And now he's looking at these qualified plans that he was doing previously. And whereas a few months ago, he was looking at pulling the funds he was at 100. Today he's at 79.
All right. So I'm going to come back to the question you asked me a second ago, Joey.
All right.
You said, is this the best time for us to be pulling out? And my answer is no. And that may shock you. Do you know when the best time would have been?
Never put $1 in it.
Oh, well, there's some wisdom in that. It would have been last year.
Okay.
And here, let me
explain. Yeah.
But you're going to probably say, well, but they didn't have this provision that allowed me to get the money out if I was pre 59.5 without a 10% penalty. But I'm going to go back to to Ernie's example there. If the guy had $100,000 in his account end of December last year, right? Mm-hmm. Had he taken it out that day, whatever his tax rate was, plus 10%, right? So right. Let's just assume his tax rate is going to be the same no matter what. So we can do the easy math. If he had 100, if he pays a 10% penalty, how much does he put in his pocket before he pays his normal income tax? 90,000, right? You guys keeping the math at home with me? All right, let's look at this year. Ernie, you said his account went from 100,000 to how much?
To 79.
To 79,000. Now this year he gets to avoid the 10% penalty, doesn't he?
Right.
So how much does he get to put in his pocket before paying his income taxes?
79.
So when would have been the best time for him to have done it?
Last year. Absolutely. December.
So I do want to make the point that there lies one of the issues we deal with these accounts is, do we get to control the result of the actual investment itself?
No.
And I would even question, is it an investment?
I almost don't want to go here because
you're hiding something. You're about to pounce on us with something.
Well, in an investment, that is something that we have a reasonable expectation of receiving back our principal with interest. When I want to go invest in land, right? I have a reasonable expectation I'm going to get my principal back plus some interest.
Well, because there's collateral behind it.
It's, to me,
in that case,
that's an investment.
Right.
Right. To me, I look at the stock market the way 99.999% of the people invest in it, and I don't see investment. I see speculation. I see casino. I see red 44. Now, by the way, I've spent some time in a casino. I don't do it anymore. and I have watched people at the craps tables keep track of the numbers that have been rolled as if there's going to be a pattern. This is the kind of ludicrous. That's when people are tracking the stock market. They're doing the exact same thing as if there is a pattern in that stuff. The odds, it is speculative. You may be on the good side, right? You may have betted on a horse before. it may have won. That's speculation. So I would say from an outset, market drop is definitely an issue. What other issues could you see, Joey, out there?
Well, I to be honest with you, what I'd love to point out is something I think was really challenging to me. It was eye-opening. When we did this whole thing, we showed the tax train video. You remember the one David McKnight put out?
Yeah, love it.
And, CPS, we've already talked about them, but one of their tax attorneys came to that event and up to that point would have told you, me, anybody, even within their client base, deferring taxes is a good thing. Like he would have been going in that same kind of flow, if you will, that accountants and just anybody in general has been taught and has kind of perpetuated. And he said, when he left there, he said, wait a minute, something's wrong here. Like what you guys are talking about makes all the sense in the world. These, especially in the high earners of the world, they need to stop trading and deferring to some later date. They're putting themselves in more risk. And to me, that was really impactful because he was not buying any longer that continuous train of thought that, oh yeah, defer taxes, you can grow, compound on the government's money. These things are lies that we've been taught. And it was just great to hear him kind of come to that realization.
Well, I think of the same thing as we move a little bit deeper into this. These are external factors, right? The market drops. We don't control
the
that.
Volatility, yeah.
We've got the cost of taxes when they change. All of those sort of things are really, really hard for us to decide when to make decisions. All right, let's go a little bit deeper. Let's get internal because sometimes we fight that internal game. Ernie, do you hear anybody when they're in relationship to their 401ks and IRAs trying to defend them? And if they do, what is that internal defense mechanism that keeps them on the side of the qualified plan?
I think one of the most common objections is we're looking for cash flows to optimize. Where are we putting cash and is that working for you? Do you need to make a decision to remove those? As they say, absolutely, I'm willing to do that, but I don't want to give up my match.
The match. Man, if you're putting in 10,000, we'll match, 2,600 of it. Hey, that's free money. Did you guys know that?
Free.
By the way, listen.
It's 100. That's a 26% return.
Well, let's go back. I want to challenge this too, and I think we've done this on a previous episode. It's been a long time though, so some of our new listeners maybe doesn't want to go back and listen to how bad we were in the audio back then. If you're getting a match, and let's just assume that match is $1 for $1 up to 3%. And for simplicity, I'm going to say we make $100,000. So we put in $3,000, they match $3,000. Is that 100% return on your money?
Of course.
Is it?
That day it is.
That day it is, right? What happens after that day? Does it continue to be 100% return on your money? No. Over time, over a 30-year period of time, it may enhance the result by maybe 2.5% to 3%. Ultimately, it may pay a fraction of the taxes for you because every day it goes out. I make this analogy way back when, is that if I told you, Joey, the world was flat, you would think I was silly.
Yeah.
But do you think I could get down on the Earth's surface at some point and find a flat spot?
Yes.
Absolutely, because I can get down on a really minute microscopic level and see that area. It's the same way people look at the match. It's 100% return on my money. But here's the thing is how long do you have? You got to put $3,000 in for them to do that, right? Now you got to wait 30 years to get it back out. You got your money's locked up. We're talking about a prison. It's locked up without parole for 30 years. Hey, that is no good.
No.
That is not, in my opinion. Is there any other reason that you could think of?
All I'm saying is that qualified plans were a sales tactic. And how do you have a sale unless you have something of value that you're trying to offer up as some sort of like you're bringing somebody into a trap, right? And that's like that cheese in the middle of the mousetrap. Man, we're going to match your money. That's 100% return. All these things that you're talking about and spewing out, those things are lies to bring you into the trap. Now, I will say this. Another thing that I have witnessed even recently is that these qualified plans leave you with no peace. Okay. No peace of mind. Just recently had a couple, an older couple at our church that said, man, you know what? I really dislike my job, to be honest with you. And I'm going to go ahead and I'm just going to retire. And this was right before, this is probably February 2020, right before the COVID crisis, right before the market drops. And to be honest with you, at the time, I felt really bad for him. I was like, oh my gosh, how's that going to affect him? He came up to me, was talking to me, and he said, you know what, Joey, I know you shared this in Sunday school about the market being volatile and all this. He said, but I'm just going to go and I'm just going to see how long it lasts. And if I have to go back to work, I have to go back to work. So in the back of his mind, day one, he hadn't even been a month in, he knows he has the possibility he's going to have to go back to work. Now, when is he going to feel confident to pull out what he properly needs to live on today without that having that in the back of his mind?
So think about that. What is that internal question that he always has in here, and what he's trying to overcome? Really, what's speaking out or yelling out of his being is, I don't want to be at this job anymore.
Exactly.
Let me out of here. I'm willing to do whatever it takes. And because I didn't plan in a different way, right? I planned in this accumulation approach. Yeah, I'm just going to have to let it play out. However that is, I'm going to have to play out. Now, Joe, you yourself had a 401k. As we start to get closer to the guests, by the way, you're listening to this as a podcast, and we're getting ready to jump into a hot seat segment with one of our existing clients and somebody who's actually done a podcast with us, Mark Hargucci. And he's going to talk about exactly what he's done recently, how he was able to navigate this CARES Act, how he was able to get money out of his 401k, both in the form of a withdrawal and loan.
Yeah, I left that part
There's
out.
very few people who've been able to have realized that you can do both. And Mark has navigated those waters, and he's going to share with us exactly what he's done. But if you're not a part of our community, if you're not a part of our inner circle, here's how you're going to get access to this. You're going to go to wealthwithoutwallstreet.com/inner circle. That's where you're going to be able to get a part of our member-only community that's going to see all the things that we're talking about today and much, much more. So I want you to take time and do that. But Joey, really quickly, as we get ready to wrap up this segment, I want you to leave those who are on the podcast part just one little bit of story going back to your history on 401ks.
So if you missed this prior, I'll share really quickly. My process of learning about infinite banking, I realized, man, my 401k is a bad deal. I'm getting matched 100% by Wells Fargo, and I still could not wait to get my hands on that money. So what I said, man, I got to get this money out of here. How am I going to do it? And there was no provision except for a loan. That was the only way to get access to my money that was tied up in this multi-hundred thousands were in this 401k, and I could not get my hands on it. It was so frustrating. And so what did I do? I figured out a way to borrow. There was no CARES Act at that point. And I borrowed up. It said you could have up to 2 loans at any time and no more than $50,000 or 50% of your balance. Now, I'm not in any way, shape, or form giving people advice, but I'm telling you, I figured it out by reading the documents of our plan. So do your own research. But anyways, I did that. I pulled out the $25,000 in a loan. I funded my first year premium, and I had that cash value. And then the second year, I went back and took out a second loan and paid the second year premium, and then used the cash value to pay off the first year loan to my 401k. There's a lot of moving parts there, but the point is this. I realized I didn't have access to my money. I didn't want to defer tax any longer because that was a bad deal, especially as I was continuing to increase my income. And number 3, what could I do with that money in the meantime in something that I knew and understood, like private loans and auto loans. And I mean, now we're into land flipping and all these other things, but in our own business, how much bigger is my return now than just hoping and waiting in the Wall Street casino? And it is just a game changer for our family.
All right. We're now ending this podcast. Thank you for joining us. If you have not become a member of the IBC Inner Circle, here's your chance. Go to wealthwithoutwallstreet.com/inner circle so you can get the rest of this edition where we sit down with Mark Hargucci and we open it up for Q&As, both to our guests and to us on the subject matter. Thank you so much for following us today. See you on the next episode.
This has been the Wealth Without Wall Street podcast. Don't forget to subscribe to the show to break free of the Wall Street mindset and begin building wealth on your own terms in places you understand so that your wealth will never run dry.